Welcome to Peoples and Things, where we explore human life with technology. I'm Lee Vinsel. Technologies of money. That might be an interesting theme to pursue here on this little podcast, brothers and sisters of the P&T. There are so many interesting books today on digital payment systems, for instance. Perhaps I'm especially thinking of media studies scholar Lana Swartz's work. And we'll definitely be having Lana on here sooner than later, maybe even a few times. And as you may know, I don't really like to get into boring, endless, utterly pointless conversations about how to define technology or to extend that notion beyond the breaking point into silliness to say things like, oh, democracy is a technology or whatever. I mean, come on, what are we trying to do here? But it doesn't seem like a stretch at all to me to say that coins and printed money are tools. I mean, mints, among other things, are foundries. And for example, historian Ann Daly is doing fascinating work on coinage in the early American Republic. We hope to have her on here eventually too. Oh, and another person we should have on, Bernardo Battiz-Lazo, who's doing fascinating work on the history of the ATM machine and what it meant for the banking industry, including all of the maintenance work ATMs required. Yeah, that's the good stuff right there. But if we want to think about technological systems built around money in the 20th century, we can do little better than to examine the little plastic rectangles most of us carry in our wallets. The good old credit card. Now, Americans, along with Brits and members of a few other nations, have a special relationship to credit. The average American household carries about $8,000 in credit card debt, reaching an aggregate total of $1.13 trillion in the fourth quarter of 2023. I was just reading today that about 36% of Americans have more credit card debt than savings. And sadly, credit card payment delinquencies are once again rising to pre-pandemic levels. Moreover, credit plays a particular role in the American economy. As you'll hear later in this episode, I've been reading a book edited by Mark Blythe and colleagues titled Diminishing Returns: The New Politics of Growth and Stagnation, which argues that consumer debt plays a crucial role in creating economic growth in the American economy in an era in which wages have stagnated. Think about that for a second. Debt has become essential to the American growth machine. Well, how did we get here? We learn that story in Sean Vanatta's great book, Plastic Capitalism, Banks, Credit Cards, and the End of Financial Control. Vanatta, who is a lecturer in economic and social history at the University of Glasgow and senior fellow at the Wharton Initiative for Financial Policy and Regulation, begins his narrative in the Great Depression when the U.S. government encouraged extending credit as a way to stoke consumer demand. And he ends it in the 1980s and 90s with U.S. states like South Dakota and Delaware racing to the bottom to accommodate the demands of credit lending banks. Vanatta's history is unflinchingly bleak. In fact, its ending might be the bleakest one I have encountered in years. But I applaud him for his realism, because a little over 15 years ago now, the United States and many other nations experienced one of the most intense financial crises in modern history. And yet almost no real financial regulatory changes came about as a result of it. So what exactly would have to happen to foster real positive change? It is hard to imagine. Still, while depressing, even depressing as all get out, Sean Vanatta presents us with a fascinating story of the rise of the credit card business in the United States. I had a great time talking with Sean and learned a lot from him. And I bet that you will too. Hey, get excited! Sean, thanks so much for taking the time to talk to me today.
I'm really delighted to be here, Lee.
So Plastic Capitalism is a neat book. When you talk about it to strangers, if that's something you ever do in your life, what do you tell them it's about? What were you trying to do with it?
Yeah, I mean, I guess I try to tell them that it's about how in the United States we used to have all these small local community banks, and now we have 4 or 5 major, huge global banks. And so it's a way to kind of think about that story, but through this thing, the credit card that we all sort of have in our wallets that we're very familiar with, trying to understand how banks try to use credit cards to break out of the regulatory system that made them small and local institutions. That there were, a handful of aggressive banks that saw credit cards as a way to overcome the limits that the government had placed on them. And, over time, they kind of succeed in this vision, but it's, it takes some twists and turns. So that's part of it. And then, the other thing I would probably tell a stranger is that, we as citizens used to have a bit more control over the financial institutions, that there was more opportunity to have a say about, the rates that you're charged on your credit card bill, or, the size of your local bank. So that this is also a story about that, about how there was, imperfect, but there was some greater measure of democratic control over the financial system, and that the credit card story is kind of a story about how that got broken down.
Mm-hmm. And how'd you get into this topic in the first place?
Yeah, I mean, there's like a short answer and a long answer to that. And the short answer is I was in credit card debt, and I thought, this is strange. How did I decide that this was a good idea? The longer story is one of those, I think, typical kind of grad school stories. As an undergrad, I got degrees in marketing and history, marketing degree because I wanted to get a job, a history degree because I had the credits to do it. And I worked for a year in marketing, and I didn't like it. And so I thought, well, my history professors seem to be having a great time. It seems like a great job. I loved my history classes. I hated my marketing classes. So I took the GRE. I did pretty well. I thought, okay, I'm going to nail this. I'm going to go to graduate school. I'm going to get a PhD. I'll be a historian. But I didn't have any idea what the profession was, what actually being a historian meant. And so I applied to a bunch of kind of top level programs and just got flat rejected across the line. And so I went back to the University of Georgia, where I'd done my undergrad. And there are a bunch of the kind of new history of capitalism folks, Bethany Morton, Stephen Mim, Shane Hamilton. And it was in reading Stephen Mim's book, A Nation of Counterfeiters, that I came across this argument, or one of the arguments that he makes, which is in the West, in the Western United States, where there wasn't very much physical money, that for some people, having high quality counterfeits of notes of good banks, this is in the era before the Civil War, if you had that kind of good, bad money, that was better than actually having the banknotes for state chartered, supposedly state regulated banks that were just, printing notes and not very stable or secure. And that just kind of blew my mind open in the way that it takes this thing that you think you understand, which is money, and it really just breaks it down. And so I, at that point, kind of thought, I want to do this sort of history, something that lets me think about the financial system, to really unpack the way that it works, and to try to show that things are not really as they seem. But of course, having that idea and then finding a topic with which to undertake it is something else. So part of what drove me to credit cards is what I said at the beginning, is I had racked up some credit card debt as an undergraduate. In talking to Mim about his book, he emphasized that often for scholars, like having some personal hook or personal motivation is really important. And so that led me then to start asking questions about, first about kind of the culture of credit. Again, why did I think this was a good idea? Why was it normal for me and my friends to be taking on this kind of debt? As 18, 19-year-olds with no income or prospects. And then, to really get into the mechanics, which is what the book is a bit more about.
And one of the ways you kind of told us, outline the story when you were explaining it to begin with, is that it's a story about centralization, right? That we go from these local banks to these big, powerful centralized banks. And was that like how early in the process did you realize that was an important part of the picture? Was that there pretty early, or is that something you reached over time?
I'd say it's definitely something I reached over time. I mean, the book, like my research on the book kind of started at the end. So it ends in the 1980s when some of the biggest banks like Citibank and Chase relocate to states like South Dakota and Delaware that don't have interest rate restrictions. And they're then able to kind of broadcast that lack of regulation through their credit card networks to cardholders across the country. So I was kind of starting there. And then I knew what I wanted to do. So I went from UGA, I went and got my PhD at Princeton. And when I started at Princeton, I knew that like this was the project I was working on. And so I kind of decided I was just going to like know everything there was to know about the bank card industry. And so that kind of brought me back to where the book begins in the 1950s with these hyper-local credit card plans. And it's only kind of then from working from one end where there is no centralization. All credit card plans are city at most, kind of statewide, to the nationwide plans that Citi and Chase and these other large banks had by the early 1980s. That it raises the question that you raised, which is just how do we get from this hyper local world to this very concentrated world?
Yeah,
and I mean it's definitely a major theme in the book.
There's a couple other themes I wanted to pull out. One that I liked is that at least, I think for at least the first 2/3 of the book, you really focus on the role of the states. And I wondered if that, I think this is a kind of like somewhere the history of, this is probably something that happens in cycles or something like that, but I feel like the history of the states and the local has been kind of come back around in the last decade or so. It's something Richard John, as an example, makes a big deal about. So there too, I wondered, like, is that something that just came up through the research, or did you know that like state level stuff was like where an important center of action?
Yeah, I mean, it definitely comes through the research because it's clear from the beginning that states especially have this consumer protection and especially like credit price regulation role. And that's, again, why states like South Dakota and Delaware take on so much power by the end of the book. But as you say, like there are people like Karen Tawney, Brent Siebel as well, have been thinking about how with the New Deal, we have this conventional story where the federal government just becomes dominant.
Yep.
And regulation kind of takes over. And really, what my book does, I think what their books do in different ways, is to really show how the New Deal structures primarily or essentially relied on this sort of local governance. For me, it's local financial governance. It's a recognition, in the New Deal legislation, in the ways that the New Dealers are thinking about the regulatory structure that they want to build, that states will have this essential role, that state, regulation of consumer prices, regulation of bank branching. So if you think about, how do banks get big? Well, they build branches, but in states like Illinois, where you grew up, right?
Yeah, yeah.
Banks couldn't build branches, I don't think, until the 80s and maybe later. So there's this real effort in the New Deal to inscribe local politics and local power. And you can tie that in, of course, to the power of Southern elites, Southern congressmen, that, federalism really is core to the New Deal governance project. And then, states retain that power and remain as sites for political contest, in this case over credit prices and the terms of credit, throughout the post-war era, throughout the period that I'm interested in.
There's a couple other concepts I wanted to kind of get on the table. One of them is you especially in the beginning of the book, you get real, you go into like how this fits into like the racial history of the United States. And you have this neat term, predatory inclusion. So I think we often think of like racial politics as one of exclusion and segregation and such, but you talk about predatory inclusion. So what is that concept?
So that's a concept that I take from Keeanga Yamada Taylor's work on housing markets. But the idea is that you can offer, right? You sort of create something like the credit card, where access to consumer credit is vital for full economic citizenship, for full participation in the economy. And the idea is that, well, you offer inclusion to groups that had previously been excluded, but by charging higher prices, by saying like, because non-white people are, their employment is more sort of precarious because they have lower incomes. Well, of course, that means that they're less creditworthy. And if they're less creditworthy, well, we have to charge them higher interest. And so, yes, we want them to be involved in the financial system. Yes, we want the financial system to be open to everyone, but we have to recognize, right, that there's a logic to, credit. And so to participate equally, there have to be higher rates, right? This is an argument that bankers and other kinds of reformers who want to open up markets are prone to make. And so, again, part of what some policymakers are doing is trying to get away from strict regulations in terms of credit prices and say, well, actually, if we get rid of credit price regulations, we can make the markets more inclusive. But that inclusion comes at a financial cost, again, for disadvantaged people. So you can participate in these markets, but it will cost more. It means that you're more likely to, be in debt longer and struggle to get out of debt. And so the inclusion is not really all it's cracked up to be, and is often, quite dangerous to population.
Other guests I've had on talk about how it's expensive to be poor, and also racial minorities, it turns out, in this version. So the last kind of concept I want to kind of get on the table before we just kind of hop into the story you tell is relates to another way you could have told the story, which in the epilogue of your book, you say like, that you're kind of telling a story about financialization, but you don't use that term. And I'm so glad you didn't. I mean, I'm a kind of contrarian, so I like to avoid these kind of terms. But I was reimagining your book as a history of financialization. I'm like, oh man, I'm so glad that it wasn't that. But still, if we were going to play it out like that, imagine, kind of like rewriting the book description as a history of financialization. What would that through line from the Depression to the present look like?
Yeah, I mean, I think that often the scholars who are interested in financialization, who use that term, especially sort of sociologists, geographers, tend to have a very present focus. And so there's this idea that from the New Deal until the 1980s, everything was great.
Yeah.
That markets were well regulated, that finance was under control. And kind of corollaries to that are like there wasn't really innovation, there wasn't really this regulatory avoidance, that bankers, again, like as entrepreneurs were restrained, right? Yeah. And the evidence of that is like, well, there weren't very many bank failures, and we had good industrial jobs. And then something happens, right? It's it's the Volcker shock, it's
neoliberalism.
Exactly.
Yeah.
There's a lot of different ways that you can play out when, why financialization kicks in the late 1970s, early 1980s, but that's kind of the story.
Yeah.
And then, there's a lot of, like, the actors in these stories are often, well, it's shareholder value. So it's Milton Friedman, but it's also just like, corporate governance mechanisms that give managers more incentive to pursue short-term profits, or it's about, trying to redistribute. It's you kind of have like this sort of social crisis about distribution because women and racial minorities are now making claims on the state because of the civil rights movement and the women's rights movements, but the state is restrained, and so instead of trying to meet those obligations, it turns to the market. Right. And that, again, those are focused on certain groups of actors, Congress in particular, but then also, again, these sort of corporate managers. And for me, that just misses like what the bankers are doing through this whole period. And so part of what the book is really trying to do is say, like, bankers and other financiers are the agents of financialization. Like they, have a very strong interest in taking down the New Deal, like from day one. And even when they kind of assent to it, they're working with policymakers and with others to try to find ways to revive banking, to generate new profits, to find new markets or consumers. And so that's really the story here. And in another kind of stuff that I'm working on too is like you can really see these efforts to change the structure of the economy, to push finance to the fore, beginning, in this case, with credit cards in the 1950s, but in all sorts of places, if you look at financial services, that's what you would see.
Mm-hmm.
And I think, like in my book, I'm really committed to this idea that there is a New Deal kind of regulatory structure that policymakers at the federal and state level agree on the kind of core regulatory principles, even as stuff shifts around. But I think you could tell a story over this period that would be about regulatory erosion, which would just be about all the different ways that this system that we think is like really robust and solid, and then all of a sudden neoliberalism hits it with a hammer. A different way to tell the story would just be like, look at all the 1,000 cuts that are occurring over this time, all the ways that in different parts of the economy, regulators or businesses are just shaving away a bit at this power, a bit at this structure, so that it's not like we had something robust in the 70s that was then knocked down. It's just that it collapsed under its own weight. And that's not the story that I am interested in. And I think part of what I'm trying to do is emphasize this democratic aspect, especially of state level governance. But I think you could come at it from a different perspective and tell a different kind of story.
Yeah.
That would be credible, but again, would rely on these agents starting in the 40s and 50s, really trying to dismantle the system, and succeeding in incremental ways until it really all comes down.
Yeah, that's beautiful, man. I think that's great. And so I mean, you've now set us kind of perfectly up. You've come at it a couple different ways so far, but you start the story in the Great Depression and New Deal with the rise of credit but also the regulation thereof. So can you kind of motivate that for us? Like, why was consumer credit like appealing as a partial solution to the Depression?
Yeah, I mean, I think at least as policymakers understood it, and here I focus a lot on Mariner Eccles, just because, and partially because his papers are on Fraser, which is the Federal Reserve Archive for Economic Research, which, like, big plug for Fraser, is an amazing resource. And, he's also one of these kind of underconsumption theorists. He was reading Keynes. People said that, I think he claims that he wasn't, but actually he's citing him in some early speeches. So he's very much of the view that the reason that we're having such a hard time getting out of the Depression is that we built this economy where, because we have consumer credit in the 20s, because we're buying cars on credit, because we're buying durable goods on credit, we have an entire industrial system, and we've employed all these people to make these things that are then being sold on credit. And so our spending power is far larger than our earning power. And so the only way then to return to that level of employment is to get the consumer credit back in the system. That's the way that we get people hired, and then they're buying more stuff. And so, housing is a key part of this where, if you're putting credit into a house, then
Right.
people are also buying cars and washing machines and lace curtains to put in the house. And Eccles was himself a banker, so he really had a keen understanding of the ways that the reasons bankers were reluctant in the first place to invest in new businesses in the Depression, and also the ways that government guarantees saying, if your borrower defaults on their mortgage, we'll pay you out. The way that those guarantees would be a cheap way for the government to incentivize bankers to lend when they really weren't
Sure.
in the early part of the New Deal. So I think that's kind of where the motivation comes from. And I'm reasonably sure that like the evidence shows that stuff wasn't that important in the 1930s to revive the economy. There's some, but it's really in the post-war era where bankers, having kind of learned how to do this and become willing to engage in consumer lending, that bankers really, invest in this business and kind of commit themselves to this business.
Yeah.
So it's as much about like creating the kind of institutions and structures and motivation inside banks as it is the actual process of recovery, which proceeds a bit differently.
Yeah. It's interesting. I've just, when I was reading your book, I've just kind of been bumping into this argument in other places in my life. Like you see it actually, literature's on the US economy, in the last 50 or more, even 70 or 80 years, as opposed to other economies. So like there's this Pettis and Klein book, Trade Wars or Class Wars, and there's this Blythe, Mark Blythe, the austerity guy. I've been reading one of his edited books with colleagues about kind of credit and stuff. And it's like the U.S. economy and the U.K. are like very credit heavy, and they're like, this is part of the macro policy in a way that it's not in Germany and lots of other countries where debt is much smaller. So I felt like you were kind of giving me a kind of glimpse into like how this starts to develop early on, that the U.S. is very credit dependent.
Yeah, and there's, really active arguments in the 20s where people are saying like, this is really dangerous because if you're committing your current income to, consumption, if you're taking on this credit, well, where's the next cycle going to come from?
Right.
If we're all, buying on credit now, who's going to buy the stuff next week, next year?
Right.
And, the answer is we'll just take out more credit.
Yeah.
Right. And that's like the fear through, essentially through like the 50s and 60s. And then it's just like, we're committed, there's even debate this. Now we'll kind of debate around the edges of like, well, do consumers have too much debt? Is that what's slowing things down? It's no longer a debate about like, should we all go into debt to fuel the economy? It's like, well, given that we've done that, how should we manage it or how should we think about it?
Yeah.
And the answer is like, well, instead of having to pay off your car in 2 years, why don't we take 3 years or 4 years? That'll help, right?
Well, and there's HELOCs and stuff. I mean, we introduce all these other mechanisms eventually, that home equity line of credit. So yeah, I hear you, man. So take us back. All right, now we've kind of motivated this like credit, why the federal government might be interested, why the banks might be responding. But tell us about like, what are the first? Take us to the birth of credit cards. What are these things initially? How are they structured? What policies around them? Yeah, just tell us about that.
Yeah, so there's lots of different retail businesses, so department stores, gasoline companies, even like railroads that are experimenting with what we might call like card-based payment systems. So the card is both a kind of identification media, so that the store clerk knows that you've been granted credit, and it will kind of streamline the credit granting process. And then often it like integrates with the store's kind of billing infrastructure, right? So there's a whole series of like complicated billing and accounting machines, these mechanical machines that often the cards are kind of like plugged into, and you've got the carbon paper reading off your address and all that kind of stuff. So in department stores, this is a way, what are called charge accounts, are a way to get, elite customers to buy a lot of stuff. They don't pay interest on their charges. They have 30 days to pay them off. Similarly, like gasoline cards are about, enabling motorists if you're driving around the country or traveling salesmen to, buy gasoline and charge it. And so where banks get involved is in the 1940s during the war, department stores begin adding a credit feature so you can finance your charge purchases over time if you pay some interest. And department stores also buy sort of expensive billing equipment to facilitate this credit. And this is all the result of federal government regulations on consumer credit during World War II. The idea is that we want to minimize consumer purchases to restrain inflation. And so the department store charge account and eventually revolving credit is a kind of loophole to get around that. And then later is a way to help manage that system more effectively. So department stores have made this investment. They're coming out of the war. They're looking to expand. They're looking to follow consumers into suburbia. And so they're marketing credit heavily as the way that consumers should, return to prosperity. That consumers shouldn't use your savings to buy stuff. You should use credit to buy stuff. And so as this happens, what bankers notice is that small merchants who are bank customers, right? So we're imagining now, small single office banks in the suburbs of large cities or in small towns. That these banks, their customers are the merchants, they are the store owners, and so they're realizing that the store owners think that they need credit to compete, or the bankers are telling the store owners that they need credit to compete with the department stores. And so you have this guy, John Biggins, who is in Brooklyn in New York, who initiates one version of the bank charge plan, which eventually gets picked up when he moves to Paterson, New Jersey. And then there's another guy, Edward Donahue, who's also on Long Island. So there's a kind of cluster around New York, which of course is a big vendor of department stores. And then in the early 1950s, other bankers start to pick up this idea that, okay, we can unite the merchants in these communities into kind of like a shared credit plan run through the bank. And this is a way to help these small merchants to compete with the department stores. So that's kind of like the initial momentum, or at least the story that bankers tell about the first one.
And so then how did bankers kind of converge on credit cards, as you put it, as a kind of technological solution to the constraints and kind of regulatory woes that they face?
Yeah, I mean, I think like early on, so in the early 1950s, it's very much about trying to tap into consumer markets. Is that bankers, commercial banks tended to focus on businesses, right? It's kind of in the title. And bankers recognize that it's consumers and consumption that are driving the economy. They can see how, again, big department stores are taking customers away from their main clients. This is before computers, but they can see these billing technologies. They can see the ways that these investments can potentially pay off in terms of streamlining these credit operations and making them efficient and potentially profitable. And they have I think this is probably true in other industries, but there is just this kind of community aspect to banking where, because of the geographic regulations, bankers aren't actively competing with each other except for the couple bankers in your local market. And so in the banking trade press, they're really promoting new ideas. There's a recognition among the editors of publications like the American Banker that bankers need new ideas to remain relevant, that there are other financial institutions like savings and loans, insurance companies that are competing in kind of adjacent or overlapping areas of financial service. And so again, there's kind of this initial momentum where you have all these guys, they're all guys who call themselves like the pioneers, right? They really see themselves as like, to continue this metaphor, like blazing a new trail in terms of what banks can do and the ways that they can serve consumer markets. And then there's a kind of major change in the late 1950s because Bank of America, which is the largest bank in the nation, and Chase Manhattan, which is the second largest, both kind of see this and move into the credit card market. And so that's where, again, it's an effort to reach consumers. It's an effort to engage with these small businesses that motivates those moves.
Mm-hmm. Through doing the podcast, I've discovered that there's like a book structure I really like. It's kind of a dialectical thing where you've got a movement and then a counter movement. This is something I'm seeing in a lot of books I like. In yours, you've got these banks like converging around credit cards as like, they're innovating in a really deep way and, and kind of technological and other business model ways. And then there's a kind of counter mobilization on the parts of states and consumer advocates and stuff. And so they're counter mobilizing around things like credit prices and consumer safety and the structure of these financial markets. So how did these kind of counter mobilizations take off and what did they look like?
Yeah, so I appreciate you bringing that up. I mean, obviously that's like the Polanyian move. You're forced to read Polanyi in graduate school and you're like, well, actually this is pretty accurate. I'd say my book, what I tried to do is have two of these. So, and I'll describe them briefly and then we can maybe dig into them.
Yeah.
One is a movement and counter movement, and the counter movement is successful.
Right.
And then the second is movement and the counter movement fails.
That's right. I was going to bring that up. I really liked that as a picture. It was great. Yeah.
Yeah. So like everything that I've said so far is kind of the prehistory. So there's momentum behind credit cards. There's a vision of this as a way to get into new consumer markets. But I should also add that before the 1960s, it's not clear that this is going to work. That a lot of the banks that start in the credit card industry drop out.
Sure.
I mentioned Bank of America and Chase start in 1958. Well, Chase gives up by 1962, which is not working. And so it's only by the mid 1960s when Bank of America is clearly succeeding, and when sort of new information technologies, especially mainframe computers, banks are beginning to adopt them, that a lot of bankers begin to see credit cards as the way forward. And again, it's this building momentum where clearly consumer markets are where bankers need to go. Clearly the suburbs are where bankers need to target. A lot of banks, because of these branching restrictions, are locked in these downtown skyscrapers. Consumers are moving to the suburbs. And so in the mid 60s, bankers just kind of jump into the credit card market. So Bank of America licenses the bank, what is called the Bank AmeriCard, which I don't know, should.
Oh, look at you. Nice.
Bank AmeriCard.
Yeah. For folks who are listening to the audio version of this, if you check out the YouTube version, there's a nice poster, Michigan Bank AmeriCard. Beautiful.
So you can see here, I mean, like part of it is I've got these things all over my office. I'm not going to do a show and tell for the whole podcast. So part of it is that you have these local existing plans, and some of them join the Bank AmeriCard. So the Michigan Bank AmeriCard, there's a small sign on it that says Michigan Bank Card. So the Michigan National Bank had a credit card plan, but then affiliated with Bank of America. So Bank of America, the biggest bank, says we're going to create this national system. And then other banks that either wanted to get into the credit card market or were already in the credit card market, like Marine Midland, which was the second largest card plan, they then tried to counter-organize effectively. So you get first regional card associations. So there's one in Chicago called the Midwest Bank Card Association. And then you get a kind of effort to create a national network to compete, which is called Interbank, which eventually has the MasterCard. And so on the one hand, there's this kind of story about network building and about competition, and it's I'd say energetic, but it's like kind of rational and logical. You can see the ways that banks are trying to respond to competitive pressure to create these networks. They're building on long-standing interbank relationships called correspondent banking that, again, are all tied to the fact that banks are stuck, right? They're in geographically confined markets. They want to create a national system. They have to build networks to do it. But then what they do is to get cards in consumer hands, they mass mail cards. They mail hundreds of millions of cards from 66 to 1970, creating a massive consumer backlash against unsolicited credit. And so the kind of first counter movement is in part about high credit prices. So credit cards and other forms of retail credit are expensive. And so there are consumer and labor organized movements at the state level to try to regulate credit prices. They begin before banks get into the credit card market, but then continue to be motivated by the deluge of bank cards. There's then, kind of congressional efforts around consumer protection, which are really about limiting unsolicited mailing, about protecting consumers from liability. So, if you lose your card and someone spends $1,000 on it, you don't want to be held responsible for that, especially if you never asked for the card to begin with.
Yeah.
And then there's a kind of third strand about credit card fraud, which is linked to that, where on the one hand, consumer and labor groups want to structure the credit card market in ways that are favorable to them. And so that's the kind of first two stories about prices and about protection. But it's also the case that banks need the government to structure the market, right? That market rules benefit market participants, and the bankers are especially concerned about credit card fraud. And so they use this narrative of the mafia and professional criminals to really try to induce the federal government to police the credit card market. So that's the kind of the first arc of the story is you have this massive unsolicited mailing campaign. You have these successive efforts at the state and then at the federal level to protect consumers and banker efforts to get strong federal protection. Federal protection actually falls apart for a variety of reasons. But in the end, by the early 1970s, credit cards are a kind of generic product that it's really hard for bankers to differentiate themselves in the market because the kind of web of regulation has been pulled over the credit card market. It was a way to offer a product that wasn't very highly regulated, that could, reach new consumers. And by the early 1970s, it was kind of masked over, covered over by the regulatory structure.
Yeah. And so another thing I really like about your book is that you see the centralization that we're very familiar with today, and the bigness and all that. It's not coming from planning, which is kind of, I don't know. I need a twistier mustache for this kind of look, but you know what I mean? There could be these shadowy figures in the background. I mean, not that there aren't shadowy figures, but that you see it as kind of coming from clumsy, I think you put it, ad hoc. I mean, kind of it's a muddling through process that gets us that. So I wanted to kind of ask you about that. And, part of it, I want to kind of I'm just setting you up to talk about the Marquette Supreme Court decision at some point here.
Yeah, I mean, again, I think part of what I see is the way that kind of our system of federalist governance works is really muddy and strange and confusing. And so often what's happening is you have a kind of regulatory effort that's happening at the state level where you're arguing in the legislature. And you have a kind of regulatory effort that's happening at the federal level where you're arguing in Congress. And so there's kind of ideas that are moving back and forth, and one is influencing the other. And then, someone sues someone else, and then there's a court decision that you have to account for. And so there's just this way that, nothing ever ends when the law is passed.
Right.
There's always been, that's when things kind of get interesting, because then you're trying to negotiate the new world that the law has created. And so again, part of what the book is trying to show through a lot, kind of detailed state level jockeying over some of these issues is that the governance is really messy, but that the actors know how to use the system, that a state attorney general knows that he can sue, J.C. Penney and make a practice that is kind of not really probably is illegal, but isn't illegal until there's a court case. It's well, okay, you're making me bring the court case to demonstrate that this practice is illegal. So it's all these kind of savvy actors trying to use the system. And so, an example of that, as you point to, is the story of the Marquette decision. So scholars who study the credit card industry focus on Marquette because it's this case where the Supreme Court says credit cards are regulated in the state where the bank is located. And this matters now because banks like Citibank and Chase, which are located in states like South Dakota and Delaware, are able to take those states' laws and export them across the country.
Yeah.
Say, well, it's South Dakota law that governs your credit card account. But in the 70s, banks couldn't relocate, or at least they hadn't figured out how to do so. So the case is really focused on much smaller differences between state laws in Nebraska, in Iowa, and Minnesota. And so what I try to do is show how this case developed from a Nebraska bank, the First National Bank of Omaha, which is is a Bank Americard affiliate. Its markets are Nebraska, Iowa, Minnesota, maybe also South Dakota. And what it's doing is, it's mailing cards into these states. It wants regulatory uniformity, right? It doesn't want to have to figure out, well, if my Iowa customer drives over to Minnesota, which law?
Yep.
The bank just wants the law where it is, because that simplifies things.
Totally.
Certainly the bank has influence with its local legislature, but it wants, again, kind of some sense of legal simplicity and order. But if it's mailing cards to people in Iowa, in this case, a couple called Fred and Edna Fisher, who get a card from them in, I think, 1968, if you live in Iowa and you work in Iowa and you got your credit card at your house in Iowa, and it comes, by the way, from your Iowa bank,
yep,
you just assume that it's Iowa law that's going to govern your account. And so it's really this fight where, on the one hand, you have kind of state attorney generals who are trying to bound their local credit market to say these are the places where Minnesota or Iowa law is in effect.
Mm-hmm.
You have consumers through their attorneys also bringing suit and trying to fight these issues, and eventually it reaches the Supreme Court, where initially, the Supreme Court seems to be on the side of the bank. So that the case that comes before the court is this bank, the Marquette National Bank, or the National Bank of Marquette, which is in Minnesota. Minnesota has really strict interest rate restrictions, but it allows banks to charge annual fees. And so the theory is that, if a bank from outside of Minnesota offers credit cards that don't have an annual fee, but have a higher interest rate, then the Marquette Bank isn't, the competition is unfair. And so Marquette gets Minnesota to pass a law that says, well, any bank that issues credit cards in our state is subject to our laws. And this comes before the Supreme Court. And initially the Supreme Court, or at least some members of the court, are tend to side with the states. They say, well,
Sure.
We live in a system where we've given states the authority to regulate finance within their borders.
Yep.
Credit cards are undermining that authority, and so we should rein this in.
Yep.
But the Omaha Bank hires this guy Robert Bork, who maybe you've heard of. And so Bork basically just jokes his way to a victory, essentially saying that the Marquette Bank should have hired a better advertising agency. So it's a really skillful argument. Bork is a very skilled jurist for all his other problems, and ends up convincing the court that actually no, the state in which the bank is located is where things should be regulated. Mm-hmm. And so again, it's significant, and it's significant now because of what banks had done with that decision, but it wasn't that big a deal at the time. There weren't a lot of amicus briefs saying, you should take this view or that view. Banks were kind of ignoring the case because banks were still confined within states, and they still would have to negotiate price regulation with their local legislature at the state level. And so there wasn't an obvious opportunity to use this decision, whichever way it went, to their advantage. That only comes later, but we get there because of this complicated process involving legislatures and courts, state and federal. There really is the kind of meat of federal financial governance, through this era.
And so you see Citibank as a kind of early innovator in this period, the kind of next wave. What does Citibank do that's different than other folks, and how does it kind of take off in a different direction?
Yeah, I mean, Citibank kind of like comes in the last 3 chapters or so of the book. I think what's important about them is they have a very aggressive corporate culture. They're really focused initially on offshore banking. So they have more offshore or foreign branches than any other bank, any other US bank. In their offshore branches, they're really working at this kind of regulatory manipulation and finding ways to work around geographically bound rules, right? So you have a transaction that maybe is happening in Germany, but tax rates in Germany are high. So we'll book the transaction in the Cayman Islands, so we don't have to pay those taxes. They get very good at that kind of regulatory manipulation in the 1960s and into the 1970s. In the 1970s, you get more international competition from large European and Japanese banks. And so it had been very profitable kind of international banking market for US banks. Again, this is during the Bretton Woods era and just after, when the dollar is the dominant global currency. So US banks have a real advantage. Those profits begin to kind of shrink because of competition. And so Citibank then seeks to return back to the US market, where it sees consumers as a key driver of future growth.
Yeah.
And so they have this, I think Citi executives have a very different vision of the way that the US banking market can and should work, which really isn't bound by geography the way that most other bankers are thinking. And so it's kind of from there where they pick up the credit card as something that not only can they target like a local market in and around New York City where they have branches, but they could mail credit cards anywhere across the country. And so in the late 1970s, I think it's 1977, Citibank then starts sort of nationwide campaigns. So what I talked about earlier when I talked about banks rushing in the market, mass unsolicited mailing, again, that's really focused on local markets. So if you're a Pittsburgh bank, you're still only mailing cards to Pittsburgh customers. You're not mailing them to Sacramento or New York. So any sort of large regional bank is still going to have a very neatly defined local market. And so it's only in the late 1970s that Citibank sees, well, actually cardholders really associate with, the Bank Americard or the MasterCharge. They don't really associate with the bank that's issuing the card. And so if we just mail out these offers for new Visa cards, then consumers will take them and they'll be perfectly happy with them.
Yeah.
Because they're going to work just the same. The network infrastructure is there. The card is going to work. And so we can then create this nationwide consumer market using the existing network infrastructure, which had been built up, to that point.
Yeah. And you kind of flagged this earlier. I mean, you have this nice structure where it's like counter mobilization. First time is success, second time is failure. So tell us about Carter, who, if you're watching the YouTube, you can see his pretty face in the background, and like why they weren't able to kind of bring credit cards into their regulatory efforts, even though some other regulatory efforts succeeded.
Yeah, I mean, again, I think it goes back to what we talked about at the beginning, Lee, where the nation, our national economy is dependent or was dependent on consumer borrowing.
Yeah.
So this is really building up over time. It's becoming more and more entrenched. And credit cards, especially bank cards, become an important component of that. So they're both kind of symbolic of this. Anyone who's uncomfortable with debt, with their own debt, is going to have a kind of complicated relationship with their credit cards. And this then becomes a kind of national, theme, or, it's a kind of common way to think about the national economy as like, well, we have this credit addiction. And, there's kind of added on is this problem of inflation, where, inflation had been a sort of slow burning problem throughout the post-war era. There had been concerns about the relationship between consumer credit and like economic growth or the business cycle throughout the post-war era. But it's in the 70s when inflation really heats up. And this is also when Citibank is launching this massive nationwide campaign. So there's increasing ties or arguments that, well, it's actually access to these credit cards that is enabling people to participate in anticipatory buying, where you're buying ahead of inflation because prices are lower now than they'll be in the future. And so that's, fueling the inflation. And so Carter kind of comes in because, of course, it's in his administration when this problem really peaks, both in terms of inflation, but the oil crisis. There's a sort of spate of economic issues that he's trying to manage. And so on the one hand, he's receptive, I think, to the economic argument that consumer credit is spurring inflation. But he's also has this kind of deeply moralistic argument about inflation, about our failure to combat or to kind of deal with the oil crisis. And so it's this that kind of comes together in his administration. They toy with credit controls essentially throughout the administration. And then in March of 1980, they say, okay, we're going to do it. And they institute a credit control policy, which again is both like a kind of rhetorical policy. Credit cards are bad. We need to rein in our addiction to credit. And is a kind of interesting and complicated nuts and bolts policy where the Federal Reserve is requiring lenders to deposit money against new credit extensions, which makes it more expensive to extend credit, which because of state interest rate caps means that lenders don't want to extend new credit. And so there's both a kind of consumer side force where consumers are saying, we agree, we're going to back off credit spending, and a kind of lender force where lenders are saying it is too expensive to extend credit, so we're going to pull back on our extensions. And this causes a really sharp economic downturn. So it's, I think, something like an 8% decline in GDP in the first quarter of 1980 or the second quarter of 1980. So when the control policies are in effect. And so Carter and the administration quickly backs off the policy, but there's a sense in which by asking consumers to stop using credit, you realize very quickly that you just can't do that. The economy is entirely dependent on credit spending, and so that's a kind of end of that type of approach. That we have totally committed to a political economy that relies on consumer borrowing, and then unless you can somehow replace that kind of fuel for the economy with something else, then then trying to stop it is just going to drive off a cliff. And if you're president and it's an election year, driving the economy off a cliff
doesn't look too good. No. Yeah, I mean, part of this, the Blythe book I mentioned earlier, I mean, one of their points, the book is called Diminishing Returns, the New Politics of Growth and Stagnation. And one of their arguments in that book is that this credit-driven growth becomes even more important when your economy stagnates, right? And so like post-70s, I mean, this is where we see all these kind of new credit mechanisms spreading because, as you're saying, we become so dependent on it that you can't like really cut it off when it's a really important engine for you. And you don't know what other engines you got, frankly, Yeah.
Yeah. Well, and I mean, that's part of the story then that I try to tell in terms of thinking about why places like South Dakota and Delaware
go there.
Become these havens for these banks. Because, South Dakota, primarily an agricultural state, really suffering throughout the 1970s because of kind of the decline of agriculture, because of, it's young people are leaving the state. It has, I think, like the lowest wages of any state in the union in 1980 or 1981. So it's obvious that like if a bank comes to you and says, listen, we can give you, white collar, non-polluting jobs, and not just us, but if you do this, you can kind of create a whole industry from scratch. It's obvious that would be enormously appealing to local policymakers. And, South Dakota does this. Delaware similarly is trying to maintain its kind of business friendly reputation. And they copy verbatim South Dakota's legislation, and then they add new tax breaks for large banks, so long as those banks employ at least 100 people in Delaware.
Yeah.
So there's this clear incentive. Delaware is a state which was much more industrial, chemicals, some auto manufacturing, I think. But because of deindustrialization, finance is really appealing, even if these end up being, largely like call center jobs. You're still able to generate employment in your state in a moment when the traditional, the kind of breadwinner liberal industries of, agriculture and manufacturing are on the decline. And so it's clear that, if federal policy isn't offering these states a better deal, if we're still committed to a system where interstate competition for jobs and industries is how we want to run our political economy, then you can't really fault the states for taking these actions, even as they have really damaging, effects on, you can't essentially then regulate credit at the state level anymore once, banks can relocate to these onshore, offshore locations.
Races to the bottom, I guess. So your book has like a bleak ass ending, man. I mean, I thought I was bleak, but I'm just gonna read the last couple sentences here. All right, it's a longer paragraph, but I'm just going to jump in where I'm going to jump in. Nevertheless, the privileged consumers who shaped these debates had a clear idea that unrestrained finance would lead to unrestrained indebtedness and economic precarity. As bankers sought to escape financial regulations through unregulated revolving credit, these consumers used their power to forestall the fate. They harnessed the Federalist political institutions to maintain and extend the New Deal's moral economy of credit. Eventually, however, once banks showed state policymakers that financial capital could move, consumers lost their grip on the regulatory levers. The future they had anticipated, feared, and fought rushed headlong into being. Mic drop. Yeah. Dude, So, I mean, like, I don't do this to all historians, but you are also a part of this Wharton Initiative for Financial Policy and Regulation. So, I mean, your book ends in a bleak place because, hey, that's where we're at, and it's bleak, so why not, But I wonder, like, I'm not putting you on the hook for this, but I'm wondering, like, what, do you have any hope? Is there, like, are there things we could do to make this better? or do you think we're just in a corner and fucked? I don't know.
Honestly, I think I saw this. I think I saw something like this. I was trying to finish the book, and somewhere on Twitter, someone was just like, I'm kind of sick of historians having these hopeful endings.
Yeah.
Like, well, but if we all just get together.
Oh, yeah, the collective action thing. Jesus Christ.
Right? Maybe it was you. I don't know. But I read that, and I was like, you know what? Actually, we are fucked.
Yeah.
Like, this is just
good. Yeah.
There's nothing good. Like, I mean, it's a point that I tried to make at the beginning where, I wrote this book in the wake of 2008, right? And wrote this book about, it starts in the New Deal when, for better and for worse, the New Deal tries to rescue capitalism, but it creates really strong governmental structures to try to restrain capitalism, to try to, make the world a safer place. And we didn't do that after 2008.
That's true.
We didn't change anything after 2008. Yeah. Like, there's some fiddling around the margins, but I don't think that you can make a convincing argument that anything significant changed and that we have done anything to sort of restrain a political economy of financial exploitation that we live in. And so that's kind of like, I didn't want to end by saying, but maybe
if we all come together and I know.
No, I just think like, there's a future where things are better, but like the bleak part is it takes a crisis to make that happen.
And we had one and it didn't, and so, yeah.
So I think that's really like, that's the bleak part is that there was arguably an opportunity to really stake out a different path. And to some extent, because we had economists in power whose lesson from the Great Depression was like, don't let the Depression happen because then the lefties will get in power. Or the Nazis, right? Like, we went one way, but Nazi Germany went another. I think that there was a major opportunity that was missed, and it's hard to imagine really changing direction without without something really catastrophic happening, which is really bleak.
Yeah.
Because, like, like in the news, so we're recording this. I don't know. Should I tell listeners?
Yeah,
we're
yeah,
recording
yeah.
this
It's
in
cool.
right? So there's the Discover Capital One merger. So, the book is about monopolization and centralization. Like, here's an example of that. There's some efforts by like the CFPB, the Consumer Financial Protection Bureau, and I think the Biden administration to really rein in bank fees. And that's great.
Yeah.
But it's just like reifying the system where it's like, cool, you won't be charged, account fees, but you're still going to be charged 30% interest on your $5,000, $10,000, $30,000 of credit card debt. So it's just, creating supports for a system that's broken. So yeah, I mean, like, there's policy stuff. Like, I think it's unambiguously good that you're reducing fees, but I also think that the consequence of that will be poor people will be kicked out of the banking system.
Yeah.
And so unless you do something dramatic where you say, actually, what we're going to do is create a public bank that will guarantee people access to necessary financial services, unless you're willing to do that, then these fees, the fee caps may have a negative effect. And that's kind of, comes back to the predatory inclusion thing. And so part of what you read in that paragraph, it's like well-off white consumers created price controls around credit to protect themselves from excessive debt. That the New Deal was, in part, a guarantee to white households that they would have access to low-cost finance, which would help them to buy homes, which would help them to engage in consumerism. But that finance would be low cost, it would be short term, so they wouldn't get into dangerous debt. Certainly, there's still bankruptcies went up and up and up during the post-war era. So like there's some of that, but there's an effort to create a controlled system for privileged Americans. And they fought to maintain that system, recognizing that non-privileged Americans would be excluded or would have to access fringe finance, would suffer in the market as a consequence. And so, that's we're kind of back in that scenario where it's good that we're trying to protect people, but in doing that, we're not protecting everyone, and we're not dealing with the consequence of that. We're just pushing it off somewhere else. And until we think radically about how to change the system, and I think public banking is a way to do that.
Public option's an interesting possibility here. Yeah.
Then we're just going to keep going down this road.
Yeah.
That's my.
Whoo! All right. How about what's next for you on the project front? Do you have a next thing? This book when is it coming out?
So the book comes out May 24th.
Cool.
With Yale University Press, and I would encourage you all, if you want an author discount code, just send me an email.
Yeah.
Don't tell my editor that I said that.
It's cool. It's cool. Yeah.
No. So, I mean, Lee, like, as I think you recognize, as an early career person in this environment, right? Like, I have like 10 other projects because that's what I thought and still think I have to do to survive. I mean, I'm really lucky. I have a good job, but so I have submitted. So a co-author and I, this guy, Peter Conti Brown, who's at Wharton, we submitted a book about the history of bank supervision to press 2 weeks ago.
Oh, cool.
So we're kind of trying to deal with that. So the kind of arc there, the question that book is asking is like, how does financial oversight work over time? Yeah. So if a bank examiner walks into a bank in 1870, like, what are they looking for? How do they understand financial risk? What are they trying to do? What can they do to try to guide bankers to engage in better behavior? And then, imagine the same question in 1930 and 1970. And the kind of takeaway is that supervision, this process of continuous oversight, is a mode of risk management where private bankers and public officials kind of negotiate who's going to take on the residual risk of the financial system. It's a kind of debate and a kind of fight until the New Deal. In the New Deal, the federal government says we own the risk of the financial system. And then kind of from the New Deal forward, policymakers are saying, well, these bank examiners are really good at making sure the banks don't fail. Maybe they'd also be good at anti-discrimination policy or consumer protection.
Right.
So there's this process then of saying like, well, we have a good, useful institution. Let's layer some more stuff on it. So the arc of that is kind of 1789 until the 1980s. So I'm kind of doing that. And then I'm also working on a project about public pension systems. So think about like, the state of Virginia's public pension system. The question is like, how do public officials invest public funds? And do they invest in public infrastructure, which is really the story until the 1950s? So it's New York pension funds, for example, that are financing the schools and roads around Levittown. And then how do they transition into stocks, bonds, private equity, things like that? So I have a couple articles there, and that may turn into a book.
Do you also deal with these pension crises? Is that part of the story too, or do you not? Is that not part of your picture? Because
So I'm trying. I mean, that's like that. I'm very much at the stage where I'm not sure. I know where it will begin. I'll just
that's cool.
In the beginning, in the 19 and then the question is like, what's a useful endpoint?
Yeah.
I've been to California and Minnesota. I'll go to Texas in a few months. So I've got records kind of into the 80s, but that's when, like the records you'll have access to kind of end, and then it's the that begin later. But I'm also really interested in stuff like anti-apartheid, right? So it's when do states become activist investors and how to engage in that kind of politics. California is really big in that, for example. So again, it's a story of financialization. It's very much about how government is using financial market, and especially engaging in and supporting a turn to private finance, which is again rooted in kind of the 50s and 60s, not so much the 70s and 80s. And then I'm just starting something on the Great Depression that comes out of the supervision work. Basically, so you have all these rural banks that fail in the 1920s. And when they fail, oddly, they have, some of them at least, have bonds from Brazil and Argentina and Bolivia. And so the question is like, why did these rural bankers buy these Latin American bonds? How did the kind of financial networks come to exist that enable them to do that? And then once they start failing and the countries start defaulting at the same time, how those networks just like obliterate and then get reborn, inspired by new American dominance of the global financial system. So that's like a next thing that I'm also trying to get rolling.
Cool shit, Sean. I love it all. Dude, thank you so much for taking the time to talk to me today. It's been really great.
No, I really appreciate it, Lee. It's been fun.
I hope you enjoyed this episode of our podcast. You can reach us with questions, comments, and suggestions at leevinsel@gmail.com or by following me on Twitter at STS_news or on YouTube at People's Things. Our podcast is distributed by the New Books Network, the leading platform for academic podcasts, so that you can find us wherever you get your podcasts. People's and Things, like most things in this world, depends on the work of many people. I want to thank my brother Jake Vinsel for writing the music for the show. I want to thank my buddy Juliana Castro for designing the logos for the podcast. You can check out her work at julianacastro.co. Joe Fort is the producer for the podcast, and Mandy Lamb is the production assistant. This podcast and other Peoples and Things programming are produced in affiliation with Virginia Tech Publishing and supported by the Center for Humanities and the University Libraries at Virginia Tech. For information about other podcasts from Virginia Tech Publishing, visit publishing.vt.edu. www.uga.edu. For the entire Peoples and Things team, I am Lee Vinsel. And most importantly, I want to thank you for listening. Thanks.